Hello and welcome. Today I thought it would be quite an interesting exercise just to see exactly what's driving sentiment. The three-pronged approach in terms of the risk parameters, i.e. China, the US and Europe, and how they're feeding into markets at the moment, how they're feeding into the currency markets and equities, and what's exactly driving them going forward and what we expect to see throughout September. First of all, we are seeing a nice melt up in risk assets. Clearly that's been seen in the Australian dollar, which is really being helped out by some diversification flows as reserve managers and other central banks look to come and try and diversify some of their holdings and pick up some of that AAA rated securities we're seeing. So recently we saw a high of 106.13 on the Australian dollar. It has pulled back a little bit as some of the risk has come out of the market and people have taken profits. But in terms of Europe, we are still remain very reasonably constructive on Europe. What we're seeing at the moment is the market speculating that the ECB, potentially the EFSF and the ESM will come out and do what's necessary to save the euro and drive down borrowing costs for Spain and potentially Italy as well. There does seem to be a gentleman's style agreement in the markets that the ECB will do what is necessary. Now the ECB are making the right noises at the moment. They are saying that they are going to come out and they are looking at buying bonds. The market wants to know how much exactly will they be buying and what's the conditionality attached to Spain, for example, looking to tap for assistance and signing a memorandum of understanding. Will there be further austerity being placed on the Spanish government, which they've already put some hard yards through their economy, and we're going to see further declines in growth going forward throughout 2013, perhaps even into 2014. Will Italy look to come and get the same conditionality? We don't expect them to. We don't believe they deserve to, and we think the technocrat government would fail if they decided to tap assistance. Exactly, will there be a troika permanently present in Spain? I.e., will there be a loss of sovereignty like we've seen with Spain, like we've seen with Greece, Ireland and Portugal as well? These are the conditions that the market want to see. Now Spain have come out and said, look, we will tap assistance, but we need to see the ECB coming out and committing to unadulterated bond buying. There are some very big clear technicalities around this, such as what will happen to the seniority status of the ESM and the EFSF and the ECB if they come out and buy a huge amount of bonds. If you are a private bondholder, if you're an investment bank like PIMCO or BlackRock, for example, and you're seeing the ECB amass a huge amount of bonds going forward, what happens if Spain defaults on its debt further down the line? They are going to be held more senior to you and your position is effectively going to be diluted. Exactly what we saw with Greece when they recently wrote off 75% of their net present value. But we are believing that something will happen, and something will happen to a big magnitude. Now, the market is still very short of euros, so we believe that the market will continue to close out of some of those short euro positions as we get into September. The Bundesbank don't seem to be on board, but they're just one vote. And Mr. Admerson, who's the German's contribution director to the ECB, is still very much on board, as is Angela Merkel. So there seems to be a divergence between what the Bundesbank want and what Angela Merkel and Mr. Admerson want. So we do believe that something will happen, but we're waiting for mid-September when we actually see the EU summit to exactly get the further conditionalities. You've also got to keep an eye on the ECB meeting, which comes out on the 8th of September. Will they cut rates? We don't expect them to, but people want to hear, perhaps we might hear some further conditionality coming through that meeting. There could be a melt-up in euro, especially against the crosses, against the Aussie, and perhaps against sterling going into that meeting. On the 11th of September, we get the EU proposal on a single banking licence as well, which is going to be interesting to see. And on September the 12th, we get a Dutch election, which will be interesting to see how that goes. We also get the German vote on whether the ESM, the second bailout, which we saw recently, is constitutional in itself. So there's some of the things we're looking forward to. So looking at Spain. The other big issue is what's happening with Greece. For a long period of time, a lot of people have said that Greece will be looking to leave the Eurozone. Now, we don't expect to see that happen anytime soon, and we would expect them to come and identify 11.5 billion euros worth of cuts from its deficit for that 12 to 13 meeting. If they manage to fulfil the Troika's requirements, the market will then start to unwind some of these bets that Greece are going to be looking to leave the euro anytime soon. And there could be a good chance that Germany then come out and say that we'll give you an extra 2 years to meet your deficit targets, which again the market will like. We do not want to see Greece leave the eurozone, regardless of the fact it's only 3% of European GDP. It will set a roadmap for other countries to leave the European Union. So our preference as we come into these meetings, event risk, is to see a higher euro. What will happen with euro dollar? Well, euro dollar's trading in a range at the moment between 122.50 up to 124. I think you've got to look at the US dollar side of the equation. We don't. My personal preference is that we're not going to see a QE3 package being announced at the September meeting. Now, September 12th is when the next FOMC meeting is. If you believe there's going to be an expansion of the balance sheet, if you believe the Fed are going to come out and print money, then you'd expect to see euro dollar rally up to say 126, 127, the top end of the longer term range. If you don't believe that's going to happen, now bear in mind we have had some very good housing data recently, we've had some good retail sales numbers, and the service ISM numbers have come out quite strong, as have the recent non-farm payrolls, then you believe that perhaps we're not going to see that, and that's been reflected in the bond market, where we've seen 10-year Treasury yields push from 1.37% up to a recent high of 1.55%. So we've seen a repricing in the bond market of QE3 expectations. The consensus is probably about 60% of primary dealers who deal with the Fed still expect to see QE3. But I believe that they will look to keep their powder dry until after the election, and perhaps we can see something after then. But I personally don't believe we're going to see QE3, so I believe we could see further upside in US yields as people look to sell out of some of those bonds. That could support the dollar-yen trade, which we think could trade up to about 81 if that happens. The other issue then is what's happening with China. Personally, I'm relatively neutral on China. Now, I do take into consideration that they can do more on the easing side. We know they've got scope to cut reserve ratio requirements, and they can cut interest rates if they so desires. They're probably more likely to do something more on the infrastructure spending side, so on the fiscal level. But at the moment, you can see the anecdotal evidence that China are slowing down. Their GDP growth is at worrying levels. Well, in comparison to where they have been, compared to other nations, still very, very strong, of course. Their export growth up 1% on a year-on-year basis is quite alarming, and the industrial production numbers is still quite weak as well. So there is a kind of neutral bias that I have at the moment in terms of some of the anecdotal evidence we're seeing. House prices are still under a bit of pressure, but that's probably quite a good thing, given that they put curbs to control the property market, and the export numbers are very much in line with what we've seen with Korea and Taiwan. But as it stands at the moment, I'd be looking at long euro against Aussie trade, given what we're seeing with the Shanghai Composite trading at the lowest levels for many, many years. But so they're my free trades at the moment. What's happening with Europe, and we are starting to see a melt up going into Europe, into the ECB meeting, as people do expect Spain to come out and tap assistance, and we're looking for the conditionality that's attached to that. Do we think Italy is going to do something? Personally, I don't believe that's going to be happening, but we are starting to see Spanish bond yields moving down to more sustainable levels as people start going along with the ECB trade. Do we think QE3 is going to happen? I personally don't, but there are a lot of people in the market that still happens. If you don't believe that's going to happen, the dollar looks like it could be relatively well supported going forward. And exactly what's going to happen with China, we're still waiting for the PMI numbers and the next series to come through, and we're also hoping that we're going to see more on the reserve ratio cuts going forward.